the best years are coming. I think 2023, 2024, you'll start to see silver move and eventually get beyond 30, and that's when the real excitement will kick off. I think ultimately where we're headed is probably another financial crisis. This is what's going to kick this off, and it may be 6 months from now. It takes a long time sometimes for the interest rates to push through the system and for people to finally admit that their businesses are bankrupt.
Welcome to Silver Pros, sponsored by SD Bullion. I'm your host, Yankee Stacking. I'm joined by my wonderful longtime co-host, Silver Dragons.
What's up? Happy to be here.
We welcome back James Anderson from SD Bullion to talk to us about silver. What's happened? What's in store for the white metal? James is the former managing director of goldsilver.com. Do you know what that is, SD?
I think, wasn't that Mike Maloney's website?
Yeah, that's right. And then he now is in charge of the content marketing for SD Bullion. This guy is a wealth of precious metals knowledge, SD, so let's bring him in.
Hey guys, thanks for having me on.
Why don't we just go right into it here and talk about what happened this past week, especially with the spot price of silver. And, talk about some of the interesting news too. Bank of England, Credit Suisse. Take it away.
So the spot price exploded on Monday. We saw a silver spot move 9% intraday up. That's one of the biggest moves in silver, historically on record. If you have to go all the way back to basically the fall of 2008 during the global financial crisis to find a move that big in one day. And that was back when, silver spot price was hovering around 9, below 10. And as soon as traders heard that they were going to do quantitative easing, you had a lot of people going long in silver, and spot price quickly moved up, and then by 2011 obviously ran from 9 all the way to 50 in a matter of 2.5 years. So now 3 years, I suppose. But anyways, that's what we saw today. I'm not really convinced that we're off into the races until we pass 22 and you start seeing momentum traders piling in alongside. And you start seeing higher volumes trading going on the COMEX. But right now it's encouraging to see, a week that we saw this week with silver leading and strengthening. You saw the gold silver ratio drop down to 81. It had looked like it was going to go to 100. And it reverted obviously pretty sharply in the last few weeks. So all encouraging signs, but there's still a little bit more time to go, I think, before the Federal Reserve changes its policy of raising interest rates and before something likely breaks in the financial markets, which probably leads into our conversation about what happened in the Bank of England this past week.
So what are your thoughts on the Bank of England, them announcing basically they're starting up QE again, I guess?
Yeah, so the Bank of England had to step in because allegedly pension funds were going to potentially default if they continued along that same path. And basically rates for gilts were running from, no percent negative interest rates to 4%. And they were headed towards 7 to 8%. And if they didn't step in and stop it, a lot of the pension funds that had trades on would have gone bankrupt. And so that's essentially what happened. And it's just an illustration of, we've had 5,000-year low interest rates for a decade now almost. And you had all these people put bets on, assuming that interest rates were going to stay low forever. And that's not the case anymore, obviously. They're still nowhere near where the true inflation rate is. So we still have real negative interest rates all over the world. But in terms of, what happened with the Bank of England, it's because there's all this leverage that's piled on with this idea that rates were never going up, and surprise, they're going up nominally, and things start to break. And so
the Bank of England actually forecasted a recession this quarter, Q4. I mean, central banks don't do that, do they, James?
Yeah, it's usually something that they deny until they finally have to admit there's a recession, until it's obvious to everyone. But for them to admit that there's a recession ahead of everyone else that was unprecedented. It's not normal.
And a lot of people are saying, well, yeah, that's England. That's not us. We're not going to do what they did. But aren't we just one crisis away from having an emergency session and dramatic action to stop what could be a whole host of issues across markets?
Yeah, so this past weekend there was a big push online. You saw, especially on financial Twitter, people making a big stink about Credit Suisse. When it comes to the banks, it's not just Credit Suisse. There's a whole bunch of European banks right now that have credit default swap bets or insurance filings that are going up, and they're going up to the rate that they haven't seen this many credit default swap rate climbs as we've seen in the last 10 years, and some of them are higher than they were in 2008. So you have people concerned about Credit Suisse, BNP, which is a big French commercial bank, Deutsche Bank, huge German commercial bank, UBS, which is another Swiss commercial bank.
Yeah, I think it's the C word, right? Contagion that they might be worried about.
Yeah, exactly. If you look at like the daisy chain of derivative bets between all the commercial banks, they're all intertwined. And so if one bank fails, it could lead to a cascade and a problem within the entire global commercial banking system. And so if you guys know who John Authers is, he used to write for the Financial Times, and now he writes for Bloomberg, and he's been a longtime financial writer. He talked about during 2008 when he was writing for the Financial Times about the 2008 global financial crisis, and he knew the severity of the situation because he had to go to lunch to Citibank because he had over 100,000 in his bank account. At the time, that was what the FDIC insured. Now they moved it up to 250,000.
Mm-hmm.
But he went into the bank and saw other Wall Street people there. There was hundreds of people there, and he had to wait in line, and finally got in the room with one of the bankers and basically had to put the account in multiple names of people in his family, his children, et cetera, so he could get the FDIC coverage. But that type of stuff was happening before, there was headlines in Wall Street Journal about, the fact that Bear Stearns had already failed, but Lehman was about to fail. And so these people knew it, and they were all in the banks freaking out and covering themselves. And basically, he couldn't even report that in the Financial Times because they feared that it would just increase the runs on the banks.
They hide information. They don't want to cause panic.
Right.
Well, we were talking about banks. I would like to talk about our central bank, right? The Fed. So they've been jacking up rates, and currently they're a 66% chance, if we look at the CME Group FedWatch tool, to raise another 75 basis points, right? So, I mean, is this going to push silver's spot price down at all? That seems to have been the trend the last few rate hikes.
Yeah, if you have relative dollar strength continuing, I mean, the dollar is about as strong as it's been relatively versus other major fiat currencies. I mean, you have to go back over 10 years. It's a long time. I pulled the chart. It's at a height that it hasn't been at since early 2002, right? I mean, you have the U.S. dollar stronger than the euro. I mean, if spot prices are going to be kind of weak because of that, that's good. I mean, that means you get to buy more bullion for less currency. But ultimately, it all reverses. I mean, these are fiat currencies, and by design, they're going to all fail when it's all said and done. So if you look at the system, the way the financial system works, upside down pyramid, essentially, John Exeter, this pyramid that he drew up in the 60s, and it shows the fiat Federal Reserve note is the second to lowest level of strength when there's crisis in the financial system. And so we're in a situation right now where there is, a slow moving crisis in the financial system because of all these interest rates that are rising and the fact that there's probably shadow problems underneath the system that will be admitted only later when everyone is, when everyone's allowed to know what's going on. But I think ultimately where we're headed is probably another financial crisis. This is what's going to kick this off. And it may be 6 months from now. It takes a long time sometimes for the interest rates to push through the system and for people to finally admit that their businesses are bankrupt. I mean, if you look at the amount of zombie companies in the United States, like 1 out of 5 roughly can't even meet the debt costs. They're not only are they not profitable, they only are allowed to stick around because they could financialize themselves off such cheap debt for so long. But if interest rates are rising, good luck.
Where do we go from here? Like, what's going to affect silver price the most? Is it just going to be, when the Fed stops raising rates, when we get a pivot of sorts, the dollar goes down? Is that going to be when we see silver shine?
You're going to have a situation where it's going to become obvious that the inflation, they can't stop. And the price inflation is going to continue, even though they're trying to raise rates. They would have to raise interest rates into double digits to stamp out this inflation. Mm-hmm. And it's not going to happen because something's going to break well before then. What you're going to have is a reversal of the policy and then an understanding of broad-based in terms of big money that the price inflation is here to stay. And so you'll have a movement in capital markets from a lot of financial assets into commodities probably, and then into precious metals, into energy, et cetera. So that'll just feed on itself in terms of, those revaluing higher as it becomes more obvious that this price inflation is not something that the Federal Reserve can just stamp out by raising interest rates a few 70 basis points over time. They're not going to be able to stop it. The explosion in M2 and the amount of currency in the system, that's going to lead to price inflation secularly for a long time.
In one of your videos about the COMEX, you said that the inventories are continuing to shrink. And I think you even pointed to India as being a big reason. Could you elaborate on that?
So India, thus far this year, has been on a pretty high pace in terms of how much silver they've been importing. It's been at a pace that's comparable to how much silver they imported in 2015. They may end up going over 300 million ounces in terms of the amount of demand this year in terms of physical. And I mean, that's a huge amount of silver for India alone. And then you look at the Western world and the amount of people still buying silver, especially with spot price going down recently. You have a lot of stackers who've been buying, in the United States and in Europe. So you have the combination of 1-2 punch in terms of a physical demand, and it's draining not just merely the COMEX, but it's also been draining the London warehouses. If you look at London, I believe they're down almost 250 million ounces since the silver squeeze began in Q1 2021. And I think a lot of that 250 million ounce disappearance that's happened recently is because of India's demand and the shortcomings elsewhere. They had to find the silver somewhere. It's probably coming out of London. And if you look at the amount of demand for India, their imports, about half of it comes from the United Kingdom. So my hunch is a lot of it's coming out of the London warehouses, and a lot of it's coming out of the unsecured ETFs like SLV, SIVR too. I was looking at that number today. I don't think people notice or realize yet, but SIVR, which was the second largest silver ETF before the silver squeeze began, and PSLV was third. That switched now. PSLV is much larger now than SIVR. SIVR shrunk by, I think 30, 40 million ounces. And a lot of it just in the past month, I think 20 million ounces got taken out of there. So I think what you have is a lot of this unsecured silver coming out of these ETFs and probably flowing off into stronger hands in the East, places like India. And SLV's down huge too. SLV is only, I think, 475 million ounces. And remember too, when it comes to SLV, A, nobody knows how much is truly held there. B, if you have a share in SLV, that doesn't mean anything. All you're getting is exposure to the SLV price. You actually own no silver. And so the one big thing about SLV that always bothered me is, and it happened around Q1 2021 when the silver squeeze kicked off and there was a lot of excitement in the market. SLV changed their prospectus by basically saying, hey, look, if we can't procure silver, we can't procure silver. And that's now part of the prospectus. So it says basically, if you own our shares in our trust, that doesn't necessarily mean at any point in time we can go out and get silver. If there's too much demand in the market, we can't get silver. And so what you'll end up seeing, I think, eventually is SLV is going to bifurcate even further in time as time goes along, and the word's going to get out that it's smarter if you're going to have, shares in an ETF, and you're not so big that you can afford PSLV, you may move into that instead. I can understand someone who's got a physical, position in bullion outside the financial system, and also wants to lever up with options with SLV and do stuff like that. So that there is a case to be made for it, but it's only for short-term trading. I would never consider that like a risk-free silver bullion. It's the antithesis of that.
Excellent advice. Hey, James, would you entertain us with some predictions?
Oh, sure. What do you got?
All right. So 2 questions. When are they going to admit it's a recession?
Yeah.
And second, are we going to have a very long bear market in the stock market?
So I think the admittance of the recession probably happens by the end of the year, maybe Q1 next year, at least in terms of the formal admittance. But if you just go by the GDP and how it's gone the last few quarters, I think it's pretty obvious that we're already in a recession, but it may take a little bit longer for the financial media to admit that fact. And then the fact
after midterms, right?
Yeah, I would say. Yeah. Yeah, exactly. And then the other thing is, the bear market that we're in is, it feels to me like we blew out the biggest stock market bubble of all time. And so that would just mean that the bear market is going to be a long one too. I mean, it took a long time to build that huge bubble that we built in the stock market. And I think there's reasons for it. I think that the financial powers that be wanted to build a huge stock market bubble to help out. Most of the baby boomers are long in the stock market still, and they wanted to make sure that those people had, a decent retirement. And I can understand doing that. And also they wanted to attract capital inflows from around the world to continue to make the United States the number one financial power in the world. And they did a good job of that. And so both of those things have helped the United States maintain a lot of power. And the dollar is another thing that we wield in terms of strength around the world financially. And so, yeah, I don't expect some major, crazy crash where the S&P 500 just goes straight down a wall. But I do expect a slow bear market that could go on for another 2 years.
Well, you said in one of your videos, I'm trying to remember which one it was, that you showed, I should say, that the bear market of 2000 lasted 31 months.
Yeah. Right. Yeah. And it was, and it's just like when you look at the chart, it's just a slow U, like an upside down slow U that just bled people out. And, if you remember back then, 2003, 4, 5, stock market was terrible, and everybody went into housing, and we blew up a housing bubble essentially.
If we could get one more prediction or your thoughts on silver. So where's it heading for the end of the year, and then where's it going to go next year?
So for silver, it depends really about the Federal Reserve's policy and what happens in terms of how much more they can hike the rates and how much more dollar strength we could see. You could make a case for silver to go even lower than it's gone even thus far in the year. You can make a case where it goes below 18. You could also make a case where silver goes beyond 24 and, up toward 26 by the end of the year. So that range it's not extremely helpful. I know. To me, when it comes to silver, the best years are coming. I think 2023, 2024, you'll start to see silver move and eventually get beyond 30. And that's when the real excitement will kick off. But we have to get through probably this policy change in the Federal Reserve and then whatever craziness comes out of all these interest rate hikes, because I don't think the Bank of England, I think that's just a little bit of a foreshadowing of what's coming, and it'll be big.
Also one last thing too on price of silver. If we get above 30, or when we get above 30, will we see some easing up on the premiums?
Yeah, I would think so. I mean, I recently sold Silver Eagles to buy 100-ounce bars because I just thought, kilo bars, I'm sorry. And the reason being is that the arbitrage was just too good. Like, you could basically take 500 ounces of silver and turn it into 700 ounces of generic silver, right? And so you're basically increasing your ounces by 40%. And if you have a counterparty that's not, it's not riskless. You have to wait about a month or so to get the metal because there's so much demand and there's so much back ordering. But if you have a counterparty that you trust, people could do that. And so I didn't sell all my Silver Eagles. I kept a lot of Silver Eagles because I think, as crazy as it's been, at this moment with premiums, it can get crazier in the future. And so I do think that between here and the craziest time that we'll ever see for Silver Eagle premiums is there should be some quickening up and some catching up, especially if spot rises. When you get spot beyond 30 to 40, say, it would be very, very hard for me to say that spot's 40 and you're going to be paying $60 for a Silver Eagle. I can't imagine that being the case. You'd probably be in the low 50s still.
Yeah, well, we'll have to wait and see what happens with premiums. I mean, if they're not going to be minting very many Silver Eagles, we could see 100% premium, 150. I mean, who knows how high it could really go? But
and that's exactly why I kept a lot, because I mean, this is nothing to where we've seen nothing yet. This bull market could get really, as bad as it's been in terms of bullion since 2011. It's been one of the worst investments of all time. And let's be honest, it's performed really poorly last 10 years roughly versus a lot of other asset classes. As bad as it's been, it's as crazy as good as it could get, on the other side.
Yeah, it's a good time to back up the truck, right, Yankee?
Oh, absolutely. I bought quite a bit. Hey, James, thanks so much for joining us. I really do appreciate the time.
Sure.
And thank you so much for watching. We will see you next time on Silver Pros.
Stack like a pro.